At Morningstar, we're bringing you a series of webinars looking at issues important to you and your investment portfolio. And of course, we couldn't ignore the Donald Trump presidency and the impact that that's having. Joining us in this webinar are Peter Warnes, our Head of Equity Research, and John Lykos, our Senior Credit Analyst. Here are some of the highlights. Peter discusses some of the distinctions between fundamentals and sentiment, and how sentiment drives markets, then fundamentals try to catch up.
You know, you saw the euphoria post the election. Don't forget, he was the outsider. No one, well, not no one. Few people expected him to deliver and win the election. Just before the counting had started, the Dow was down 600, and everyone expected that if he did win, the markets were going to go lower, not higher. Now, that is expectation, and that is what sentiment, and sentiment drives markets. Then the fundamentals have to try to catch up to the expectation. So November 8, he wins the election. The market has a second think about it and says, well, the economy has been below trend for years and years and years. The low interest rate environment driven by the central banks and the Fed has been at the forefront of that, hasn't basically worked all that well. We have still got, you know, some issues there. We haven't got growth. So the market then stood back and said, okay, fiscal stimulus, that's going to be, you knew he was anti kind of low interest rate environments. That meant that monetary policy was going to start tightening. He was looking at, as I said, creating jobs, and what does that do for the trade, implications of that, bringing more protectionism in, trying to talk down the US dollar rather than, you know, up, all those things. That's what he's been saying. So the sentiment around all those issues was swung from big negative to a positive. Then again, the market settles down and says, well, yeah, but how does it deliver? Yes, he has control of both houses, but how's he going to deliver that? The tax cuts can't come in; they've got to be funded. How do you get massive infrastructure spending moving quickly? Again, there's going to be time lags and all those issues. So you've got the market ahead of itself, and then a more realistic approach, looking at saying, okay, how is this going to work out? And so everyone was trying to push that Dow through 20,000. It got there, but then it's just having another think about it. So, you know, sentiment is the driving force in the markets. Again, equal expectations, but then the fundamentals have to catch up.
Energy prices were also discussed, and how Trump is backing off on green energy and renewables.
Whether his platform is going to drive energy prices one way or the other is a moot point. All you know is that he has basically torn up, the green energy situation. He's saying, hang on, we're going to back off on green energy and renewables, and we're going to start getting more and more another push into our fossil fuels and what have you. Now, what will influence energy prices more, it will be economic activity. If you can ratchet up economic activity, that means more energy will be consumed, and if you've got higher energy being consumed, then the demand side of the equation becomes, you know, a positive influence. But of course, on the off side of that, you've got supply, and the US shale is the X factor. Will they crank it up and offset the production cuts coming out of OPEC and non-OPEC? I suspect that you'll probably see perhaps $60 on oil, but then you'll see a lot more supply come in from the US, and that will put the lid on it. I don't see oil running away too hard northwise.
In the fixed income space, John discussed bond prices and the effect that inflation has.
The higher the expected inflation, then the lower the bond price, because investors require a higher rate of return. So what happened was, particularly when Donald Trump was elected, there was the promise to effectively embark on a significant program of fiscal expenditure. And as Peter's already touched on now, that could come in the form of infrastructure, for example. So the markets began to, as they do, reprice their expectations. And whilst that was happening in the US, amidst the backdrop of that was an economy which was actually beginning to look pretty healthy. You had very encouraging employment numbers and trends. For all the negative rhetoric that you did hear from Donald Trump about America not being great when he came in, he inherited a pretty an improving economy. So it wasn't all bad in that sense. Now, as that was happening, market was repricing its expectations on the economy, and as a result, the bond market started moving. And then you had Donald Trump effectively accelerating that by saying all the infrastructure, basically the infrastructure talk that came with his win. So, in the meantime, that flowed through to Europe, but also again there was some encouraging numbers starting to come out of Europe. The deflation risk, which was driving bonds to those crazy negative yields which we saw last year, began to wane, and all of a sudden you started seeing some reasonable numbers, or at least improving numbers, coming out of some of the stronger European economies. And as a result, that then started causing repricing in the bond market. So, look, it's really been driven by the repricing of inflation expectations and further supported by some of the positive talk in terms of fiscal expenditures that we've seen.
He also looked at the correlation between Australian sovereign yields and those in the US.
I didn't mention the Australian sovereign yields, but what we find is our sovereign yields are highly correlated with the US sovereign yields. Now, the only way I can see some breakaway from that would be if we see the US economy accelerating in terms of its growth, and we find ourselves falling back, almost a weakening economy. Now, we don't envisage that as our base case scenario, and therefore we expect a relatively high level of correlation with the Australian sovereign yields and the US sovereign yields.
Don't forget to join me next time. In our next webinar, we'll be discussing the recent earnings season. This will be held on the 14th of March. Details on the link below.